It is coming up on 8:30 now, so we'll get underway. Good morning, everyone, or good evening in the case of some of our speakers, or two of our speakers. Welcome to the Foreign Correspondents Club of Japan and to the latest of what we call our Deep Dive series, in which we ask panels of experts to comment on topics of current interest. And we've called our presentation today Trump, the Dollar and the Economy. But to fill in that, to expand that just a little bit, global markets, stock markets, currency markets and bond markets seem to have entered a period of turbulence. And what we want to explore today is whether markets and indeed the global economy are likely to emerge from this turbulence and achieve a soft landing, or whether it might be a hard landing or even a crash landing. So we have three experts to help us reach conclusions on this, and let me briefly introduce them in the order that they'll be speaking. Speaking from New York, we have Paul Sheard, you can see on the screen, I hope, who is author of the Wall Street Journal best-selling book, The Power of Money, and he's a former researcher at the Harvard Kennedy School and former vice chairman of S&P Global. Joining us from Washington, D.C., we have Tran, who is a non-resident fellow, senior fellow at the Atlantic Council Geoeconomics Centre. He's a former executive managing director at the Institute of International Finance in Washington, and he's former deputy director of the Monetary and Capital Markets Department at the IMF, the International Monetary Fund. And joining us here in person on my left is Jesper Koll, who's global ambassador and expert director at the Monex Group and investment committee member of the Japan Catalyst Fund. I hope they'll excuse me keeping the introductions fairly short, but they're very well-known speakers at this club. So with that, we'll kick off. Each speaker will speak for approximately 15 to 20 minutes, followed by a Q&A session. And let me just make the usual plea that if anyone has a mobile phone, a Keitai, please put it on mana mode or switch it off. So, Paul, would you like to lead off, please?
Thank you very much, Anthony, and always great to be sharing this podium with you and with other distinguished colleagues, all of whom I know very well, and we go back collectively multiple decades. So just to kind of frame the discussion, let me touch on three things: the economy, the dollar, and Trump, and I'll do it in that order, the reverse order, if you like. And starting with the economy, and I'll focus principally on the US economy here. But the economy, looks pretty strong. The US economy is performed very well. I think, generally speaking, the global economy, although it's obviously suffered in the aftermath of the COVID shock and the inflation shock and the interest rate hike shock from central banks, has come through the period in pretty good shape. I like to look at simple data just to get a handle on things. And I like to look at where GDP is relative to pre-COVID, let's say the fourth quarter GDP numbers for 2019. Where have we got to? Well, US GDP as of the second quarter is 9.4% above that pre-COVID level. For a 2.5-year period, an increase of 9.4% in GDP, it's middling, it's okay, it's not spectacular. But bear in mind that that period includes a collapse in GDP in the first half of 2020 with the COVID shock. GDP in the US went down 9.1%. Just to absorb that 9.1% decrease in GDP in just half a year, and then to recover and be 9.4% above the pre-COVID point is a pretty good economic performance. By the way, if you looked at those statistics for, say, the European, the euro area. It's a 3.8% above the pre-COVID level. Although in the euro area, GDP fell considerably more than the US. It fell about 14%. What about Japan? Well, Japan's GDP level relative to pre-COVID is 2.5% higher. And Japan's fall in GDP in COVID was actually less than the other major areas, was just 7.3%. So relatively speaking, the US comes out on top, followed by the euro area, followed by Japan. If we look at the global forecast now, the IMF is forecasting, I think, 3.3% growth this year. India, 7% growth. China, 5%. The US on track for about 2.6%. So the global economy kind of looks okay. Sticking with the US, the unemployment rate is 4.1%. Pre-COVID, it was about 3.5%. That was a puzzlingly low rate of unemployment for the US. It's ticked up a little bit, but that 4.1 is still around about 0.1 percentage point below what the Fed estimates is the full employment level of the US economy longer term. Now, they may be wrong in that estimate, but the point being, even with 500 basis points of rate hikes by the Federal Reserve between March 2022 and July 2023, the unemployment rate has just ticked up and is at a level that the Fed still regards as basically being full employment. So that's a pretty impressive factoid. We look at the stock market. I know that you wanted us to comment on some of the markets. The stock market, the S&P 500 is up about 25% since pre-COVID. And again, that includes the economic shocks. It includes 500 basis points of interest rate hikes. So the US stock market is kind of like, obviously took a hit during COVID, but it's kind of powered ahead, looked through, all of the noise and all of the problems assaulting the economy. Meanwhile, inflation has come down steadily. We look at the PCE measure, the personal consumption expenditure, the measure that the Fed manages rather than the CPI itself. That latest number is 2.5%. It peaked in June 2022 at about 6.1%. So the Fed, the Fed, assisted by natural adjustments in the economy, has been successful in bringing inflation down closer to target. Not there yet, but closer to target. The CPI numbers are a little bit higher. CPI peaked at 9.1%, is now down to a 3%. So it doesn't look quite as good in terms of the CPI, but in terms of the PCE, which is what the Fed targets at 2%, inflation is on track. So if we were sort of give the Fed a scorecard here, it would be that on inflation, the post-COVID inflation, it was, a horrendous scorecard. I don't know, give it a D or an E. The Fed and, administration more generally, and most economists, not everybody, but most economists, didn't see the inflation shock coming. The Fed certainly missed it. But I think if you went back 2 or 3 years, Anthony, and asked most economists, do you think the Fed is going to be able to bring inflation down by hiking interest rates, tightening monetary policy, starting to shrink its balance sheet without tipping the economy into recession? I think most economists, even if it wasn't their formal forecasts, their official forecasts would have said, given that inflation miss, the Fed is going to have to hike interest rates dramatically, which they did, and that's likely to tip the economy into recession. That hasn't happened. And so, so far so good in that regard. So I think the economy is, of course, you can always, the moment you say it's not going to go into recession, it goes into recession. But I think it's done pretty well, and particularly the US economy looks pretty strong. Let me say a couple of things about the moving backwards, the dollar. I don't. I've never put myself in the category of a foreign exchange rate forecaster. Foreign exchange rates are highly efficient markets. They basically discount every factor that there is potentially that could weigh on foreign exchange markets. They can only go up, down, or sideways. So they're kind of like an over subscribed problem. Or problem. There are more explanations for what happens to foreign exchange rates than there are potential movements in the foreign exchange. So I don't put a lot of weight on kind of foreign exchange forecast per se. So you're not going to get any out of me here. But just a couple of comments. One is, of course, the US dollar, does remain the dominant currency in the world, and that goes to a large extent along with belonging to the most dynamic, sophisticated, and strongest economy in the world, the US economy. Now, the US economy is not the largest economy in the world anymore, as judged on a purchasing power parity basis. China is ahead of the US in that regard at about 19% of global GDP. The US is about 15.5%. Japan is now down to just 3.5% of global GDP on a PPP basis. Now, we can argue about PPP, but that's kind of the standard that economists use to compare the size of economies. But it certainly is still the leading and most dynamic and most sophisticated economy in the world. Biggest military superpower, has the deepest and most advanced and sophisticated capital markets. It's the center of tech in the world, which is increasingly important. And so along with that goes this reserve currency status. Now, if you look at the latest numbers, and I know Hung is more of an expert in this area than I am, and he may pick up some of these points in his presentation. But if you look at the latest data from the IMF, they do kind of regular, I think, roughly quarterly surveys, if I'm not mistaken. The US is still about 60%, a little bit shy of 60% of global foreign exchange reserves. That has come down. I think if you go back 25 years or so, 2000, it was closer to 70%. So it's tracked down to about a little bit below 60%. The euro, though, is about 20% of global, a little bit below 20%, 19% something of foreign exchange reserves. The yen is 6%, a little bit less than 6%, 5 point something, but closer to 6 than 5. And sterling is closer to 5, a little bit, again, a 4 handle close to 5. So the US, although over time has sort of its very dominant position in foreign exchange reserves has eroded a little bit, it's still by far the dominant currency in the global economy. I don't think that's going to change anytime soon. Having said that, I'm on the public record. In fact, I think in a newspaper that you write for frequently, South China Morning Post, Anthony. If we go back to 2022 and the invasion of Ukraine by Russia and all of the sanctions, etc., I'm on the public record as saying I'm not comfortable with, and I certainly would not advise policymakers in the US to weaponize the dollar and to weaponize the US financial system and banking system again for geopolitical purposes. I think that is tempting fate in the short term because of the exorbitant status, exorbitant privilege, as the Giscard d'Estaing famously said back in the 1960s that the US dollar has. That exorbitant privilege, reserve currency status, is not God-given. There are huge incumbency advantages of having that, network effects, network advantages, but it's not God-given and it can be eroded. So I'm very much in the Alexander Hamilton camp, if anybody gets the reference there, of separating out, sort of financial markets, the contracts, the sanctity of financial contracts in financial markets from politicization and particularly geopolitical weaponization, if you like. So I do think that freezing of Russian foreign exchange reserves, for example, is certainly a bridge too far for me, and does set in train processes around the world that ultimately could lead to an erosion of the dominant position of the dollar. That's not something that we need to worry about in the near term. Perhaps it's not a discussion for this particular panel on the shorter to medium term, but it's certainly something that worries me. Getting back to the foreign exchange rate forecast, I'm not going to forecast foreign exchange rates, but obviously one of the prime drivers of foreign exchange rates is monetary policy. And you didn't mention in your introduction, but I'll mention it now, of course. We're having this panel as the Federal Reserve is in a 2-day meeting, as the Bank of Japan is in a 2-day meeting. So I think your result comes out today. I'm speaking Tuesday, New York Times. But we're going to get 2 important monetary policy decisions tomorrow, or today, depending on where you are. The Fed is not expected to start to cut interest rates at this meeting, but they certainly are expected to cut rates at the next meeting, probably again before the end of the year. I think most people are expecting 2 rate cuts from the Fed. That's going to be an important turning point from a monetary policy perspective. Again, particularly given the dominant position of the US dollar, the monetary policy environment will change from the US dollar side. Of course, that's also to a large extent discounted, which is always something you have to reckon with. On the Bank of Japan side, you're closer to the action than I am, but increasing reports that the Bank of Japan might move to 25 basis points today, your time. And certainly they've already signaled that they'll be coming out with their kind of timetable and protocol for reducing their JGB purchases. So again, a potential for that US-Japan interest rate differential to start to narrow, and that will be certainly one factor that factors into foreign exchange rate movements in coming months. Let me then move on to the last one. Just checking my clock here, with some trepidation and talk about Trump. Now, first of all, it's been obviously an extraordinary few weeks in US politics. The attempted assassination on Donald Trump, fact is stranger than fiction in this regard. The Biden obviously being deposed, I guess, if you like, as the nominee of the Democrats. Now, I have to say, well, I don't have to say, but I would say I've been saying literally for several years, let's say 2 or 3 years, that I did not expect Biden to be the nominee in November this year for various reasons. And it looked like I was not going to get that forecast right, and then it suddenly came right. But let me stick my head out even further just on this in this forum and say I don't expect Joe Biden to be president come November 5th. I think that what has happened to Biden once will happen again twice after the convention, and I think there'll be a strong movement to ask him to step aside, because from the Democrats' point of view, it's going to be a much stronger proposition to have Kamala Harris running as the incumbent president, with all the glow of this historical precedent that's associated with that, than it would be to have a lame duck Joe Biden hanging on until the bitter end. So that's my black swan event in terms of how things might work out there. It's, talking about US politics, I try to approach this subject as objectively as possible as an analyst. But I have to say, in the US, it's almost impossible to have any discussion about US politics without passions being excited and without people being triggered one way or another. It's very treacherous ground. So I'll just make 3 general points, and there's lots of footnotes you could add to these general points, but I'll just sort of throw them out there. One is just the general point that, when you get into these presidential electoral election cycles, there's, and the media frenzy and the political debate that goes on, if you flew down from Mars and listened to it, you would think that, the president has just this enormous power to move the economy. Because, of course, politicians claim credit, assign blame, presidential candidates or incumbents. But the reality is, particularly in the US system, and particularly given the size of the US economy, which is like a super tanker, and given how dynamic and how important markets are of all kinds in the US economy, the president has very little direct influence over the economy. It's the Federal Reserve's job to manage demand. That's not in the president's purview, only very, very indirectly through the appointments of the Federal Reserve. Of course, we'll have one in mid-2026 when Jay Powell's term expires, but that's a long way off. And the supply side, of course, presidents can influence the supply side. They have to have the Congress on their side as well, or they can do it also to a certain extent through executive orders and through the deregulation through executive order. But they usually need Congress, and these things will get challenged in the courts as well, and there'll be lots of resistances. So yes, there are some levers that a president can pull, particularly on trade and particularly on foreign affairs, but they're relatively limited. So I think when we hear all this heated debate about, what these policies are going to be like and etc., I think we need to have a dose of a little bit of cold water and say, well, probably not going to happen. If it does, probably not to the extent that's being talked about, if at all. So that's just a caution. The second point I'd make, and this may be a little bit controversial to many people, but when I look at the policy positions of the two parties, there's a lot of overlap and a lot of convergence has happened. So if you look at the major, so in other words, there's more continuity between administrations than you would think from the political rhetoric. And when you look at the major legislative achievements of the Biden administration, I'm thinking of the CHIPS Act, I'm thinking of the infrastructure bill, I'm thinking of the rather oddly named Inflation Reduction Act. All of those legislative achievements, which are being touted as significant achievements, which they are, very much have a sort of Trumpian flavor to them. They're all about industrial policy. They're all about bringing back jobs to the US. They're all about holding China accountable. And, I don't think it got as much attention as it should have. But, the May of this year, 2024, Section 301 increase in tariffs that the Biden administration imposed on electric vehicles, semiconductors, solar panel cells, batteries, steel, aluminium, etc., taking tariffs quite high in many of those products. If you'd said that was Trump, not Biden, nobody would have batted an eyelid. So there's more overlap in policy than I think is given credit for. My third point, and I'll finish with this, is if I were to identify one area of sort of policy that potentially could have an important game-changing effect on the global economy, would actually be in the geopolitical area, and it would be around the Ukraine war in particular, and relations with Russia. Donald Trump has sort of bragged that he will end the Ukraine war on day one. He's now changed that to he'll do it before inauguration. That might raise some constitutional issues. But, this is one of the big sort of structural factors, if you like, hanging over the global economy, this increasing geopolitical fragmentation, geoeconomic fragmentation, and two nuclear powers, one directly involved, one through a proxy war, I'm talking about Russia and the US, through incremental escalation, getting closer and closer to direct confrontation. And there is a possibility. I don't think it's a majority probability, but there's, I think, a possibility that under a Trump administration, because he doesn't want to be like Richard Nixon and inherit LBJ's war, that is Biden's war in Ukraine. He will have a big incentive to try to do something about that situation quickly so that it doesn't essentially hijack his administration. So it's more, Anthony, in the geopolitical area, the tectonic plates moving there, that you might possibly see something that's game-changing rather than in the economic area per se. Let me finish there.
Thank you, Paul. Fascinating, some intriguing and interesting points. Okay, Hon, let's move to you, if we may, please. Your take, please.
Well, thank you very much, Anthony, for inviting me, and thank you, Paul, for really giving a very detailed background that I can build upon. So I will make only 2 points compared to your 3. One is more continuation of your thought, which is a little bit my view on the outlook of the dollar under Harris administration compared to Trump version 2. To do that, first we have to see where the dollar is today compared to some background. So if you look at the St. Louis Fed measurement of the real trade weighted index of the dollar is way overvalued, about 30%, 30% stronger than almost 2 decades ago. The base year they used it 2006 equal 100. So right now, vis-a-vis advanced country currencies, the real trade weighted index of the dollar is 130, so 30% stronger. And basically, just, the traditional and usual mean reversing behavior of time series, it is more likely that the dollar will weaken going forward than continue to strengthen. So that's the starting point. Under Harris, I think that the policy mix that we have seen in recent quarters probably will continue. That means fiscal policy will be largely neutral or a little bit contractionary to bring down the deficit. The Bureau of Economic Analysis say that they expect primary deficit of the US budget to stay around 2% of GDP going forward. Monetary policy, I agree with Paul. We will see the Fed easing starting September throughout this year and well into 2025. So basically, from a very basic fundamental economic perspective, such a policy mix would also argue for a gradual weakening of the dollar. So I think that under that scenario, we should expect over the next 4 years kind of trend behavior of the dollar toward the middle of the long-term range. Right now, the dollar is way above the middle point of the long-term range of the dollar. Now, under Trump, I think things will be more exciting and interesting because it is very contradictory what Trump and his key advisors have been saying about economic policy and the dollar and so on. So number one, tariffs. You say correctly that Biden also increased tariffs on Chinese goods, but the key difference is unilateral nature of Trump's action compared with the building alliances and get other countries to involve under Biden, which in my view, if you want to do tariffs, that is the way to make it effective, to get allies, European, Japan, and others to join in and not do it unilaterally against both friends and foes, the way Trump has done it in Trump version 1. But tariff will be increased. Second, tax cut will continue. So the tax cut package of 2017 up for renewal by the end of next year, 2025. Under Trump, it will be extended and more. The corporate income tax rate at 21% now. Trump has said that he will reduce it further to 15%. So between more tariffs, more tax cut, the thrust of fiscal policy will be expansionary and inflationary. And that will present difficulty for the Fed to implement the easing program that they may have in mind at this point in time. So maybe still easing, but much less significant than otherwise could be the case under Harris. So the combination of that approach, that policy mix, support a stronger dollar. However, the other part of the Trump's camp really look at the trade deficit and increasingly putting the blame on the strong dollar. Trump himself said that he wants to see a weaker dollar to stimulate export. And Lighthizer, the former trade representative under Trump version 1, is reportedly could be considered for Secretary of the Treasury if Trump wins. And Lighthizer clearly said that he really wants to push the dollar down, even invoking a new Plaza Accord, getting the key countries to sit together and agree to engineer a weakening of the dollar. But I think that if Trump implements the first part of his policy, tariffs, tax cut, and deregulation, particularly in environmental protection agency, all of that probably will be making it difficult for Trump to get the second part of his wish list, which is a weaker dollar. So basically, under the next 4 years under Trump, this is my completely guess. And as Paul said, it is very difficult to forecast currency. But on a trend basis, I could see some strengthening of the dollar if Trump moved quickly to put on tariffs. He promised 10% tariff across the board on everybody, Europe, Japan, China, and then China in particular, stronger and higher tariff, including 200% on electric vehicles manufactured in Mexico by Chinese companies. If he does that quickly, so the first part of his presidency, we could see the policy mix that I described pushing the dollar up, but then that can only increase the precarious overvalue position of the dollar, the higher budget deficit and higher debt situation of the US government, and set the stage for a weaker and deeper decline of the dollar toward the latter years of Trump. So we could say somewhat stronger dollar in the first part, but then followed by weaker dollar over time. So that is basically the kind of thinking I have. It's not really forecast, but kind of a framework of mine to see if events happen that way or not. The other point which I really want to spend more time on is, again, picking from Paul's third point, is the trend of the dollarization that we have seen in the past few years. By the dollarization, I clearly agree with Paul that it is not about having another currency like the euro or the renminbi aspiring to challenge or to replace the US dollar as the key reserve currency of the global economic system. No, because clearly no other country or no other currency has all the attributes of the dollar to be able to do that. But by the dollarization, I mean, at the margin, many countries will find ways to develop alternative arrangement to really de-risk and reduce their vulnerability to US sanction, US trade action, and so on going forward. And what Paul said is true. The tendency for the US to rely on sanctions and tariffs as a policy of first choice to really try to achieve its political and strategic objective clearly cause many countries to want to de-risk themselves from that. So I can see three dimensions where the dollarization has taken place. And in my view, under Trump, with his unilateralist tendency, the geopolitical competition and the geoeconomic fragmentation will deepen even more than what we have seen in the past few years. So three dimensions. One is bilateral cross-border settlement using local currency. And the key local currency in this regard is, of course, the renminbi. If you look at the way China settle its international cross-border transactions by currency, the renminbi now accounts for 53%, with the US dollar 43%, which is a complete reversal of the situation 10 years ago. In other words, China is now able to deal, buy, sell goods, service, assets with the rest of the world and settle for those transactions using its own currency for 53%. And I think that ratio will continue to increase in the future. The counterpart of that, of course, is a growing group of countries, again, on a bilateral basis. Each one of them vis-a-vis China have been willing, able to accept and use renminbi to exchange for their own currency in settling their bilateral cross-border transaction. Russia, China, most of their trade now is settled in renminbi and ruble. But beyond that, other countries in the BRICS have trying or beginning to do so more and more. Countries in the Middle East, the UAE and Saudi Arabia, have done transactions using renminbi. And in Asia, in particular ASEAN country, more and more countries are doing so as well. So right now, it is beginning to get into a critical point. But I think in the next 4 years, if the geopolitical situation becomes even more divided and more acute, this tendency will strengthen. The key help here is really the series of bilateral currency swaps that the People's Bank of China has been signing with more than 40 countries. totally $500 billion now. I can see that will increase in the future, and the range of countries entering into these bilateral swap with China also expand. So that's number one, more use of local currency to settle bilateral cross-border transactions. These are kind of reducing the scope of the US dollar being the supreme currency in the system. So at the margin, it will be kind of, diverting some clearing action away from the dollar, and it will grow in the future. Not any one currency will emerge from that to challenge the dollar, but a host of currency, meaning local currency, will provide the tools to achieve more independence or less exposure and less reliance on the dollar. Number two is something that Paul mentioned, the share of the dollars in global reserves. Basically, from 2000 until now, the share of the US dollar declined by 71% to 58% of the fourth quarter of last year. But if you adjust that for the foreign exchange and interest rate effect into the valuation of the reserve funding, the share of the adjusted dollar now is about 56%. So it's pretty sizable decline over the past 25 years or so. Again, not to the benefit of any competitive or competing currency like the euro or the pound sterling or the yen, but to the benefit of a group of smaller currency, including the Canadian dollars, the Australian dollars, the Swiss franc, and the renminbi, which assume a larger share compared with 20 years ago. Now, if you throw gold into the portfolio of reserves, then the share of the US dollar would be even smaller, because in the past 2 or 3 years, basically many major central banks, spearheaded by People's Bank of China, have been really embarked on a large, significant gold buying to increase, to allocate more of their reserve into gold, increasing the share of gold in their reserve by between 1 percentage point to 5 percentage point, depending on the country. Russia, in particular, increased the share of gold in its reserve by 5 percentage points. This will continue as well. So I think that overall, that is another dimension that I highlight, kind of at the margin, more effort to diversify away from the dollars, going into other currency and gold. And last but not least is increasing use of the renminbi in international financing activity, also driven by the fact that in the past 2 years or so, Chinese interest rate have been much lower than US interest rate. And therefore, from the point of view of borrowers, you benefit by borrowing lower interest rate currency. So the share of the renminbi in the Chinese banks' international lending has increased from 10% 10 years ago to 35% currently. And this trend, I think, will go ahead and increase, again, depending on whether or not the Fed's easing move will converge interest rate with China, like the convergence that Paul expects for US and Japanese interest rate going forward. So if you put on 3 dimensions together, I think that over the next 4 years, particularly if Trump wins and implement his unilateral action and policy, deepening the geopolitical conflict and geoeconomic fragmentation, I would expect to see all 3 aspects of the dollarization to deepen and to intensify. So that, let's say 10 years, 15 years from now, the shape of the global payment system, global reserve system, will change more noticeably than it is now. The dollar will remain king, but over a smaller and shrunk domain than it is now. So with that, I will stop and happy to discuss in Q&A session.
Thank you very much. Likewise, fascinating. Okay, let's turn to Jesper. A view on Japan, essentially, but also on global issues, as he wants to speak, if he wishes to speak, sir.
No, I mean, first of all, thank you, for my colleagues, for giving very, very clear sort of views and fascinating insights there. It's obviously a hugely broad, topic that we're trying to guess, and there is this fear in the world. The fear is that ultimately the traditional policy levers don't really work. Paul mentioned, real GDP in the United States being a little bit higher than it was before COVID. But I mean, the costs of this have been enormous. Just over the last 4 years, the US government pumped $8 trillion into what is basically a $28 trillion economy. And the net result, if you look at real disposable income, which is to say not the nation as a whole, but just you and me, the households, real disposable income compared to 4 years ago is basically exactly flat. So an enormous increase in government deficits and really very little to show for itself. This can also be said for financial markets, because yes, thank you, the Wall Street has hit new historic highs. But then when you look under the hood, a little bit of analysis shows very quickly that about 80% of the performance that got Wall Street to new historic highs is due to barely 7 companies. The rest of the companies are lagging significantly behind. And obviously America, as always, is sort of the most dramatic example of this. But you can do a similar analysis in Europe and even here in Japan. Yes, the Nikkei, was over 40,000. But again, you actually find that, basically 30 companies out of the 3,006 companies, account for 80% of that move. So this fear of, number one, the traditional policy levers of monetary and fiscal policy not giving you the bang for your buck or the economic multiplier and the feel-good factor that they used to give, together with asset markets that have become more and more concentrated, rather than spreading the wealth, to the middle class or to mid-sized corporations. That's sort of a big fear that I think policymakers have. And then finally, I was almost amused, Paul, when you said, you would advise not to weaponize the dollar. Well, I'm sorry, the dollar is incredibly weaponized, not just since the sanctions against Russia, but that was a movement that had already happened, way before. So I think, there is a great fear, that the elites, that the people in charge of policy, have actually lost, not the plot, but have lost the tools to actually create, broad-based, sustainable economic growth, around the world. In that respect, I think that, Japan, actually stands in a very, very good position. Because, Japan has not wasted the last 30 years, but has actually used the last 30 years to basically fundamentally restructure, its overall economic system. And you're seeing that, and you're seeing the benefits of this coming through right now. As many of you know, I think that Japan will be the only G7 country where we are going to see the rise of a new middle class. And that's precisely because of the demographics. The reality of, the number of university and high school graduates declining now means that the table have turned, that indeed it now is a seller's market, you, the graduate from a university, selling your labor. You are now standing in front of the head of HR at Mitsubishi Corporation, not begging for a job, but you're saying, hey, Mitsubishi, what are you going to do for me? And as you know, it's quite interesting when you look at wage growth. Yes, aggregate wage growth is still barely flat in real terms. But when you look at wage growth amongst the people in their 20s and 30s, you actually see wage growth accelerating at rates of 5 to 7%. For example, starting salaries this year, while the shunto was up by about 5%, starting salaries for new graduates for listed companies in Japan are up 12%. So, there is actually a transfer of wealth, so to speak, into the younger generation here in Japan that you cannot find in the United States of America, you cannot find in Europe, and you certainly, unfortunately, also cannot find it in the People's Republic of China. So, number one point here, Japan is actually in a very, very good position, in the sense of that, the labor market is now structurally so tight that as a result of that, particularly for the younger generation, improvements in the quality of contracts, more part-time, more full-time jobs being created rather than part-time jobs, plus the actual price signal coming through. And by the way, it's very interesting. In Japan, people always stand back and sort of say, oh, there are all these rigidities. There's no liquidity. Well, that's actually also no longer true. We did some work with Recruit, the largest consulting or labor consulting company here in Japan, and we found that over the last 18 months, the listed companies in Japan hired more people mid-career than they hired at the graduate intake. And that's actually the first time that that has ever happened. And it's very interesting, you see that, the average price point, when do you change from one company to another company, the average price point is actually about a 12% increase in your annual compensation, which is quite interesting. So now that the labor market is tight here in Japan, you do actually have wage inflation, particularly for the younger generation, actually coming through. Which gets you perhaps, to the next point, which is, wanted to talk a little bit about the currency. And I think, economists always get scared when the simplest answer gives you the right answer. Everybody learns in Economics 101, interest rate differentials matter. And, we've had for the last basically 3-4 years, right, a widening interest rate differential with America very aggressively stepping on the brakes. The Fed rate hike cycle was one of the fastest, that we've seen throughout economic history. And as a result of that, the US going from basically zero interest rates to 5% on the policy side. As a result of that, the dollar actually strengthened, exactly as it should be, given that, here in Japan, of course, for all intents and purposes, we're still having a unchanged monetary policy regime because, yes, I know Mr. Ueda, the governor of the Bank of Japan, is starting to normalize interest rates, but quite frankly, moving from 0 to 0.1, you need a microscope to actually be able to figure, that sort of difference. The average volatility in US bond markets every day is about 15 basis points. So, 1 basis point, is not, 10 basis point is not really going to make much of a difference there. Is this going to change? My view is it is. I personally think that the Bank of Japan is going to be much more, not to use the word, but use it anyways, aggressive in actually increasing interest rates. I believe that this time next year, the short-term interest rates are likely to be at around 1.5 to 1.75 of a percentage point. And the reason is that ultimately the inflation pressures here in Japan are now real. It used to be predominantly in terms of trade shock, the combination of the yen weakening plus global energy and food prices rising, created imported inflation, which obviously reduced the purchasing power of the people. But against that, we now have genuine demand pull inflation, right? Particularly from the generation of people in their 20s and 30s, right? And as a result of that, I do think that, before long, the Bank of Japan is going to move away from just normalizing monetary policy in terms of minute adjustments to actually beginning to increase interest rates. Now, let's remind ourselves that any estimate of where is the neutral policy rate in Japan, if you look at a Taylor rule, for example, you find that a neutral policy rate in Japan would be somewhere around 2%, right? Given the Bank of Japan's inflation target, of around 2%. So we're still quite a long ways from even getting to neutral, but it will be interesting to see the impact that the gyrations in the exchange rate do have on Japanese earnings. And this is a key point for capital markets and financial flows, because whether you like it or not, 65% of the profits of listed companies here in Japan is made in global markets. And as a result of that, you do find that for every 10 yen of yen weakness, Japanese earnings get a windfall boost of around 8 percentage points. And this is in place even right now. For the current year, Japanese companies are budgeting for an exchange rate of around 145 against the dollar. So even at today's rate of around 152, right, there still is a significant windfall that you're going to get in terms of the earnings boost. But if and when the interest rate differential begins to narrow, I think we're going to see not just an appreciation of the yen and a decline of the dollar, but we're also going to see much more pressure for downward revisions on Japanese corporate profits. Because the reality, again, 65% of the earnings are made overseas, right? It's interesting, right? You look at this. Are you aware of the fact for 23 years, Toyota has not made money selling a car in the Japanese market? It's incredible. It's quite incredible, right? This market is very, very competitive. And so the question is ultimately, whether the reorganization of Japan's industry, right, greater consolidation, reducing excessive competition, either through bankruptcies or through mergers and acquisitions, whether that can actually accelerate and be fast enough to allow for greater efficiency, here in the Japanese system. I want to make one final point, which looks at, the question of American policy. And I'm happy in the Q&A to talk about Donald Trump, right? Given that he's originally from Germany, I'm happy to, to talk about this. But the reality is, as an analyst, it doesn't matter, because basically you've got an American political kabuki, right? That is, as Paul pointed out, is a permanent election campaign that needs to create permanent hanabi, right? Fireworks in order to keep us excited. But in terms of the actual policy that is relevant, right? The difference between Mr. Biden's, or what's her name? Mrs. Harris, the difference between the Democratic agenda and the Republican agenda is really minute. And that is because, there is complete bipartisanship that China needs to be contained, and that, China, as a result of that, is going to be hit disproportionately hard, either with tariffs or with other forms of sanctions in one way, form, or another. The question for Japan is whether that is actually hurting Japan more than we think. And this is, Andrew, something very interesting. Because if you look at what has changed is that Japan's exports are unbelievably weak. The world economy is not exactly, or has not been exactly weak over the last 18 months, particularly for Japan's export market. China has not been weak. The big adjustment in China, going from a 10% growth rate to a 5% growth rate already happened a couple of years ago. China basically is growing, at a relatively stable rate right now. But Japan's exports to the world are flat, despite the fact that the yen is so weak. And why is that? And the reason is, to a large extent, and this is something where greater analysis over the next couple of years, as we get more data, is going to be required, is because of American policy vis-a-vis China. If you look at the details, you find exports to the People's Republic of China are very weak, particularly from Japan's machinery and machine tool companies. Now, why is that? One reason is Japan's foreign direct investment into the People's Republic of China has declined, right? This is because not just geostrategic regions, but also labor costs in China are now higher, so that one of the most successful Japanese business people, or maybe the most successful, global entrepreneur in the People's Republic of China, Mr. Yanai, fast retailing, right, already 7 years ago decided not to build new factories in China because of labor costs being too high, better opportunities in Bangladesh or in other parts of Asia, right? But as Japan's foreign direct investment into the People's Republic of China now gets turbocharged in its decline for geostrategic reasons, right? As a result of that, you find that fewer Japanese factories are being built in China, which means that fewer demand for Japanese machinery and machine tool and robotics companies to build out those factories, right? The second reason is that you've got substitution, because you actually find, and it's perfectly normally, that Chinese machinery and machine tool companies are now perfectly competitive. Chinese robotics companies are now perfectly competitive with Fanuc, right? But the interesting thing is, if Fanuc, because of American policy, is being penalized for selling its robots or its machinery and machine tools to the People's Republic of China, right? It's, wow, you're being hurt, right, by your biggest ally, right, actually imposing sanctions, or de facto sanctions, on your companies. And this is, particularly perverse in the sense of that, the sanctions apply to the makers of machinery, but they don't apply to my investing in the Chinese competitor company. So capital flows, right, giving support to Chinese companies who are now competitors against Japanese manufacturers can still go on. But the real world competition, the real export market for Japanese companies is being hurt. So that's something that I think is worth a little bit consideration from here on. Finally, for 30 seconds, more down to earth, a little forecast. I think that the evidence of an American slowdown, are accumulating. So I do think that the Federal Reserve is more likely to cut 3 or 4 times over the next 12 months, rather than the sort of 1 or 2 times that are being currently priced into markets, together with the view that the Bank of Japan is going to be hiking interest rates or normalizing policy a little bit more aggressively. As a result of that, I think that by the time Germany wins the next World Cup in soccer, dollar yen is going to be back at 100, 110. Now that's in 2 years' time.
Okay, thank you. And embarras de richesse, as they say, we've got an awful lot of interesting points raised there. Before I open the floor to questions, perhaps I could just ask one quick question directed mainly at Paul and Hung, which is a factor which could accelerate the depreciation of the dollar. Mr. Trump, of course, is attempting to talk it down, and there can't be another Plaza Accord as such. I mean, exchange rates are floating nowadays, so it can't be achieved. But how far will Trump's comments on the dollar tend to trigger by fund managers a retreat from dollar securities, and could this significantly accelerate the rate of dollar depreciation, do you think? Paul first, and then Hung, please, if you would.
Yeah, I don't think Trump's comments on the dollar. I think you're referring to that interview he gave with Bloomberg a few days ago. I mean, to me, that is, Donald Trump makes so many comments. This is like a drop in the bucket. And there's the idea that financial market participants in particular would sort of hang on that, and that could drive market action. I think we're just so many steps away from that, Anthony. If we were talking about, yes, he won the election, we're now in January, February next year, and he's making all sorts of comments about the Fed and Treasury, and he's putting people in place, and he's putting pressure on Jay Powell to take early retirement. We get into that situation, it'll be a little bit different. But I think we're just, again, you have to whether it's economics, whether it's geopolitics, whether it's sort of whatever it is, the issue, you need a kind of decoder with anything that Trump says. And you've got to kind of, you've got to discount it heavily. You've got to kind of, reinterpret it. There's a particular Trumpian kind of language. And I think you have to be a little bit careful about this because, again, so many times I observe, sitting here in the US, Trump does say something. I think I kind of understand what he's getting at. But then the headlines in, the New York Times or on CNN or MSNBC will have taken him very literally, and not even literally, sometimes kind of distorted it and turned it into, a very real kind of proposition that is kind of just detached from really, I think what is in his head and what comes out of his mouth. So I would discount it very, very heavily.
Don't believe the press. Hung, quickly, do you want to say anything about it very briefly? You're offline. We can't hear you.
Yeah, sorry, I unmute. Yeah, when it comes to a weaker dollar, I believe in what Mr. Trump said, because he really wants a weaker dollar. He really has been obsessed with the trade deficit, and increasingly, he will use tariffs on the one hand and job bonding to get the dollars down. The problem is there's not many tools that he or government can really do to translate that into reality. Job bonding doesn't work, intervention doesn't work, Plaza Accord will not work. So basically, we are back to the policy mix that I discussed earlier, the stand of fiscal policy and monetary policy. So to the extent that the Fed can implement the easing program that all of us agree that they will do, basically the trend for the dollar is going down. So that is, roughly speaking, and Trump will get his wish. However, if he pushes his tariff increase significantly, if he pushes his tax cuts significantly, probably that will offset some of the impact of Fed cutting interest rate, and in fact, it limits the extent to which the Fed can ease. Okay. So basically, I believe in Trump, and I really think he really want to see a weaker dollar.
Yes, thank you.
It's quite interesting, right? Because don't listen to Trump, listen to the Bank of Japan. Just do the track record, right? What they want, they basically get. And it was interesting, you say intervention, is ineffective. Well, fine, it's never over until it's over, but certainly the Ministry of Finance has a very good track record, right, of actually intervening, and actually signaling to the market, what turning points are desired. On Trump himself, one point is nice, talks cheap. The question, America is not a dictatorship, whatever this guy thinks. And so the question of, will America actually have a functioning government in the sense of what is the balance of power in the Senate and in the House, after this election result, because not everything gets done by decree.
Okay, thanks. Okay, questions from the floor first. Would you like to go to the microphone? The microphone there, sorry, and identify yourself and then put your question.
Bluestein. I used to be
Yes.
a correspondent here, Mukashi, you know.
Of course, yes, sorry, Paul. I didn't-
The Washington Post. Yeah, we didn't. Yeah, my hair's a lot grayer, and used to often quote Jesper in my stories for reasons that should be obvious to you from hearing his lively commentary just now. And if I may be permitted a bit of shameless self-promotion, I've got a book coming out on the dollar a few months from now, which is the reason why I came here from my home in Kamakura, because I was very interested in the topic. And I want to push back a little on the commentary I heard from Mr. Sheard and from Tran on de-dollarization. I think they made a lot of excellent points, but I'm very skeptical of the concern that sanctions are going to cause significant de-dollarization. Certainly, countries have, you know, they already have big incentives. The Chinese, most particularly, the Russians, the Iranians, everyone else, and other countries who are concerned that they may become targets, to find new channels for operating in international markets. But the dollar is dominant internationally for some, and Hung mentioned some of the reasons. The fact that there simply is no other currency that has all the qualities that the dollar has. The fact that U.S. financial markets are so deep, so broad, and the U.S. is really the sole generator of safe assets that people want in a crisis, because they're easily, they can be sold easily without having to resort to fire sale prices. And because the dollar, absent some terrible policy missteps by the U.S., which could happen, but absent that, because the dollar is going to remain dominant, the U.S. is going to be able to, banks internationally are going to have to settle a lot of their business in New York, and by being able to cut banks off from doing that, the U.S. is going to have a very powerful weapon for a long time. There are going to be all kinds of ways that countries can get around that, and they're resorting to some of those things. But I don't think that means that the U.S. ought to refrain from aggressive sanctions just because other countries.
I don't want to be rude, but could you frame a question?
Yeah. Okay. Well, I'm interested in Hung's and Paul's reaction to this. I mean, I think there are much better reasons for being concerned about overuse of sanctions. Sanctions, hurt vulnerable populations. They irritate allies. And if they're used against really big countries, as there's the threat of using them against China, that's going to have terrible implications for the whole global economy. So there are very good reasons. I'm not saying that the U.S. should feel free to weaponize the dollar willy-nilly. I'm not. That's not my point. But and to push back particularly on one of the points that Hung Tran made about China being able to settle so much of its trade in renminbi. Yes, China certainly has moved in that direction, but the renminbi is hardly being used at all in trade between other countries. Let's say between Singapore and Jordan or something like that. But that's where the dollar, of course, is dominant. So I'm really skeptical of this argument that that sanctions are going to cause the U.S. is going to lose its exorbitant privilege, and I'd like you to. I guess what I'm basically saying is tell me where I'm wrong.
Okay. Hung, do you want to go first on that?
Yes, you are not wrong, but I think the direction is clear. And I stress that the speed will be slow, gradual over time. So number one, sanction is not just the primary sanctions that people are really pissed off with, but the secondary sanction, which really get a lot of countries very unhappy. So if U.S. puts sanction on China, all the countries that are trading with China now, and in the past 10 years, increasingly so, to the extent that China now trade with the rest of the world much more than it trades with the U.S. or with Europe, they will be very unhappy as well. Because if they trade with China, then the U.S. can put on secondary sanction against them for violating the primary sanction against China. So basically, the avoiding and the risking and reducing vulnerability to US unilateral action is something that motivates policy all around many countries, both foe and friends of the US. And that will continue, particularly under Mr. Trump with his unilateral action. So number two, as I said, it will be slow. And if you imagine China now is able to use its own currency to deal with the rest of the world for 53%, 10 years from now, if that ratio is 75%, then China really is not afraid of US sanction anymore. So I think that is what I'm trying to get at. That is a big shift in geopolitical competition, where one competitor can ring-fence itself, de-risk itself, and to the extent that the tools that the other superpower, the US, has been using will become less and less and less potent. Well, for the remaining of the world trading among third countries, yes, the dollar will remain the dominant currency, but as I said, the scope for the dollar to remain supreme will be shrinking over time again.
Okay, thank you.
Nothing quick in the next 5 years or even 10 years, but over time you will see the trend deepening and growing.
Okay, thank you. Paul, do you wish to add to that?
Well, just a different angle, I guess. I mentioned sort of Alexander Hamilton, putting aside all the economic arguments and the slow directional move that you have. There is an issue of sanctity of contracts. There is an issue of international law. I mean, we talk a lot about, the rule of law. I don't think it is consistent with international law, rather than with perhaps some, obviously, domestic laws can be put in place. And the US has taken, freezing foreign exchange assets and taken other actions based on domestic law. But I don't think it's consistent, and I'm not a lawyer, I'm an economist, but I don't think it's consistent with international law for the US to be freezing, and the Europe as well, foreign exchange reserves from almost a kind of moral point of view. And I think there are good arguments to be made for, in this very fraught world in which we live in, where there's tit for tat, and there's, you think you're right, I think you're wrong, and, vice versa, etc., to try to keep geopolitical issues sort of quarantined as much as possible from economic issues, including financial issues. If the geopolitical guys and gals are getting this wrong, a lot of damage can be done to the economic system. I would rather keep that damage isolated and insulated as much as possible to the geopolitical sphere and let those people fight it out, rather than a kind of contamination into the economic sphere.
Okay, thank you.
Can I have a quick
Sure, yeah, go ahead.
about that? Basically, Paul, if we have deepening geopolitical conflict, then there cannot be any compartmentalization of different spheres: economic, military, financial, political, diplomatic, military. They will be viewed in one continuum. That country will use what is most readily available, less costly for them at this point, and inflict the most damages on their opponent. So basically, economic warfare, military warfare, diplomatic warfare, disinformation, and so all tools will be used. And you cannot just say, this is the economic bucket, leave it alone, and don't let it interfere with military or political competition. And in fact, I might even argue that in Ukraine, I'd rather see the US using economic and financial sanction against Russia, rather than directly get involved in the military war against Russia at this moment.
Well, I would do neither.
Okay, all right. Do we have any more questions? Yes, from the floor, please.
Nishimura Freelance. Thank you very much. I have two questions. One is to the guests from the United States. And I believe that the kind of inflation is the point, one of the important points made by the Trump campaign. But if the inflation is in stable recent months, does it mean it is no longer the important point in this election, or what do you expect? What kind of discussion do you expect in the coming election campaign between Trump and possibly the Harris?
On inflation, yeah.
Yes.
Yeah.
And another is Mr. Paul. Government of Japan announced that the primary financial point balance will be balanced next year. What, do you think it has a kind of impact or psychological impact on the foreign exchange market? Thank you very much.
Okay, so who's going to go first on that? Well, Paul, do you want to lead off on that?
Yeah, thank you, Mr. Nishimura, for that question. Yeah, it's, look, again, this sort of, I've kind of alluded to this point that when we get into the political silly season, which now seems to be a continuous process, politicians on both sides or either side will say kind of things which are kind of pretty ridiculous. And if you look at one of the big Republican talking points, is how bad the economy is. And you'll hear numbers thrown out, etc. And again, I take Jesper's points, by the way. I mean, Jesper's points about okay, if you go below the aggregate numbers and you disaggregate and you get into issues of social capital, inequality, other issues, there's a lot to discuss there. But if you just take a first pass, it doesn't seem to me to be a very compelling Republican talking point that the economy is in a terrible mess, and particularly in that inflation is the problem. And if I'm Donald Trump, I'm going to do something about inflation. Well, first of all, inflation is the job of the central bank, the Federal Reserve. Now, you can have, and I've made this argument for several years, have a more sophisticated discussion about, well, shouldn't there be more coordination and cooperation between fiscal and monetary policy so that there is more of a role for fiscal authorities to get involved in this inflation fighting exercise? That argument can be made, but I don't think that's the argument that's being made in the political system here. But to a large extent, sort of saying we are the ones who are going to bring down inflation is sort of wrong for two reasons. One is, well, it's not really your job, it's the Fed's job. But secondly, it's already coming down. And by the time we get into November and then let alone January with a new administration next year, it'll be basically fighting the last battle.
Okay. Hung, do you want to add something quickly on that, please?
Yes, I think that for economists, inflation is slowing and has been stable, and going forward will be decelerating even further. But for the consumers, the men and women on the street, they look at price level. So the price level of average goods that they use, gasoline that they put in their cars, the groceries, restaurant meals, roughly 15 to 20% higher today on average compared with 2-3 years ago, and they are very unhappy about it. I am unhappy about it. So that's why inflation is indeed a serious challenge for the democratic ticket. They have to explain. They have to ask Paul to be their consultant or advisor to explain that inflation is being brought under control, which is true. But nevertheless, the psychological reaction to inflation will be something that will drive a lot of voters' behavior in the election.
Okay. Anthony, can I just add to that? Yeah, I mean,
sure.
Hung is completely right. And if I had a little bit more time, I would have kind of more or less said the same thing, that exactly the point that inflation rate is coming down, but the effect of inflation on the price level and the cost of living is cumulative.
Right.
And yeah, again, just try as an economist listening to the political debate is kind of interesting. Now, there's nothing really much that anybody can do about that, given the existing macroeconomic policy framework. But you do hear, the Republicans saying we're going to bring prices down. Well, if they mean bring the whole price level down, they're talking about engineering a deflation, which of course that would be like a red rag to a bull to the Federal Reserve and to most economists.
Yeah, good point. Okay.
For 30 seconds on that
30
debate,
seconds.
don't forget the Fed has a dual mandate. It is inflation and unemployment. And it appears as though the US labor market is beginning to roll over quite nicely. You know, that if you look at private sector job openings, they basically have collapsed and are now back to the level before the trend that we got before COVID. You know, so, you know, the increase in unemployment, you know, watch that very, very carefully, because that, I think, is going to be as important as the Fed, as the inflation numbers in the United States. Primary balance. To Paul's point, you know, I always marvel at Japan, because I think it's the only country that actually does coordinate policy. You know, and it's very interesting. I mean, Abe and Kuroda made an explicit accord of explicit and more stepped up coordination between the Bank of Japan and you know, the fiscal authorities. And under Kishida and Ueda, you know, that accord for all intents and purposes continues very, very strongly. Now, the reality of Japan being able to turn basically decades of a primary deficit into a potential small surplus next year, right, is very, very interesting. You know, and I think, you know, the numbers can actually work out. And the reason is that Japan did actually build one of the best tax systems in the world right now. You know, because of the increase in the consumption tax that took almost 30 years to get from 0 to 30%, to not 30%, God, sorry, to 10%. You know, you actually now have, you know, on the OECD numbers, Japan has the highest tax multiplier, right? So, you know, when national income increases, the amount of revenue collection, you know, accelerates very, very strongly. So from that perspective, you know, they've actually done a very good job, right? The interesting thing is, and so for the exchange market, right, the reality, of course, if you do run a budget surplus, right, or you come out of a deficit towards a surplus, right, on unchanged monetary policy, right, that would be a net positive for your currency, right? So from that perspective, you know, it'd be a little bit of an argument, you know, towards yen appreciation, right? The question mark is the great, chotto mada wakaranai, the unfunded commitments that Prime Minister Kishida in particular has made. I mean, we're doubling defense spending. How are you going to pay for it? Well, we don't really know yet, right? We're going to increase investment in deep research and university funding by 10 trillion yen. How are you going to pay for that? We don't really know. Now you're going to set up a private equity fund, right, here in Japan that's run by the government. How are you going to pay for that? Well, we don't really know, right? So there are some questions, right, about, you know, the Japanese government over the last, particularly under Kishida, having shifted, you know, liabilities or future liabilities in terms of expenditure or de facto expenditure off balance sheet, right, in public-private partnerships, right, that make the numbers a little bit murky, but for all intents and purposes, the reality of Japan's fiscal condition, right, actually being one of the very few fiscal conditions in the world where the fiscal condition is actually improving, because Japan now does have a very good tax system. That's absolutely correct and should be a net positive for the dollar, not the dollar, what is that thing called? The yen.
Yeah.
Okay.
The yen, sorry.
Okay. Okay, I have one more question, but I don't want to ask it if anyone else in the room has a question or if there's a question online. I don't see any at the moment. I'd like to bring the discussion back quickly to the stock market. Stock markets. Jesper raised the very interesting issue that, you know, the Magnificent Seven, the so-called Magnificent Seven, these companies account for something like 25% of the total capitalization of certainly the S&P index and perhaps Wall Street as a whole. It's said that fund managers and investors are beginning to become aware of this over-concentration of wealth in relatively few stocks, and it really is a fantastic over-concentration. I'd like to ask Paul and Hung, and definitely Jesper, whether you think this is going to lead to a fundamental reappraisal of stock valuations. In other words, are people going to finally realize that, that all their money is in 7 stocks or whatever it is, and start moving money out? So, Jesper, let's start with you.
Well, I mean, look, stock markets are there so that they can create little bubbles and that they can create all this little excitement. I mean, thank God we had Tesla, outpacing Toyota, giving everybody a run, even though, it's a bad car. Sorry, I'm German, so I'm allowed to say that. But it's quite interesting, so these cycles are kind of natural, but they've obviously gone to great extremes, particularly in the United States over the last, year and a half or so. I think, will the air come out? The answer is yes. I think, are we going to see spreading out into specifically the small and mid-cap space, right, in the United States? That's the billion-dollar question right now. And in my personal opinion, I actually think that, Mr. Trump, or the Republican Party at least, right, offers a more promising agenda to do that, because it is an agenda that argues for small government, that argues for deregulation, and as you do deregulate, you will reduce some of the zombie companies in the United States of America. It's like everybody talks of zombie companies in Japan, right? But there's plenty of zombie companies in the United States of America, I think if you do get a wave of deregulation, under a potential Republican administration, I think that the probability of the wealth spreading, being redistributed, right, into the small and medium-sized companies outside of the Magnificent Seven companies, I think that probability is, in my personal opinion, higher under a Republican administration than under a Democratic administration.
Okay, thank you. Paul, any comment on that, on the over-concentration of...
Well, no, it's an incredible phenomenon, and I don't know whether it's over concentration in the way you're portraying it, Anthony, which is a problem or almost a bubble that is bound to burst, or whether it is a reflection of the dynamism and the what's going on in the U.S. economy. And it just, again, I look at these numbers every now and again, just because it's just so interesting to look at. If you look at the top 10 or even the top 25 companies, we talked about the Magnificent Seven. I think the top 5, which you're talking about, Microsoft, NVIDIA, a company I'd never heard of until about 6 months ago. I'll have to admit. Apple, Amazon, Alphabet, I think are the top 5. They represent now 29% of the market cap of the S&P 500. Now, if you look at the 5 on the Japan side, you're talking about Toyota, Mitsubishi UFJ, Sony, Hitachi, Tokyo Electron, but they are about 13%. So you see 2 things there, this concentration, but you also see like new America versus old Japan. If you go down the whole 25 in the top 25 in the S&P 500, there's only 3 or 4 that even remotely look like manufacturing companies. I mean, is Apple a manufacturing company? Is you've got some pharmaceutical companies, but you could argue they're essentially R&D or very intellectual property intensive companies. So I don't know if it's a problem so much as a kind of a mirror or reflection of, we're living in this, it's hackneyed phrase, but this digital economy, this new information age. And the US, through Silicon Valley and Wall Street and private equity and everything else, seems to be emerging as the winner takes all. But apropos of Jesper's point, I don't want to sound too starry-eyed here. How much social damage is being created in the wake?
Okay, Hung, quickly, do you wish to add anything? You don't have to, but if you wish, please go ahead.
Yeah, just to conclude, I think that tax policy is also very important for the performance of equities. After the 2017 corporate tax cuts, the advertising of the explanation is that companies will use it to increase capital expenditure and investment. They did not. They used most of it to buy back shares and to increase dividend. So basically, another weak point of the U.S. Stock market is the fact that it has been underpinned to a large extent by share buybacks of companies and dividend. Now, if Harris were to win, she wants to raise the corporate tax rate, currently 21%, all the way back to 35% before the 2017 tax cut package. And I think that could really make it difficult for companies to continue to buy back share to the tune that they have done in recent years. And that could remove a big support for equities.
Okay, thank you. Jesper wants to make a quick comment.
I just want to make one final point, which is I mean, and stepping back, and again, just in my daily job as just trying to make money out of financial markets, the US is in an unbelievably good position, right? And number one, because monetary policy, well, yes, you're at 5%, so you can hike and you can cut, right? I mean, put yourself in Japan's position, right? You cannot cut. Put yourself in China's position. I mean, you've got a little bit more room to cut, but you're pretty close to pushing on a string anyways, right? You know, from that perspective, I think that, you know, the earlier discussion about the risk of de-dollarization, right? I mean, America acts fast. America is accountable. America is transparent, right? While, you know, the other bloc, which ultimately would be a renminbi bloc, right, is not transparent, doesn't act fast, right? And right now is facing its real crash test, right? In terms of, yes, you know, the unemployment in the People's Republic of China is very real. Yes, the line of Chinese people trying to get a visa to work in the United States of America every day is 2 blocks, you know, at the American embassy in Beijing, right? And yes, if you look at the data of capital flows, you can make a strong case that there is capital flight from the People's Republic of China, not just buying apartments here in Tokyo, right? You know, but pretty much, you know, around the world. So it's going to be quite interesting to see whether, you know, the ultimate strengths of transparency, accountability, and as a result of that, depth of financial markets and trust coming through. In my personal opinion, I do not believe that America, you know, that fundamental trust in the United States is going to be undermined in our lifetime. Thank you. And we are all 22 years old.
Okay, well, I hope you'll agree that it's been, I think, an interesting discussion, and I want to thank sincerely our 3 panelists for contributing to it. Obviously, there's a lot more to discuss, and as I usually say, there's meat here for a further deep dive discussion, which we will organise before very long. But thank you very much again for your expert opinions. Thank you.
Thank you.
Thanks, Anthony.